Let's now shift focus to what's really happening with GE Shipping. Let's try and map their fleet expansion, couple of things which are underway. Let's try and understand where exactly the business is headed. G.Shivakumar, the ED and CFO at GE Shipping, on the show with us right now. Mr. Shivakumar, great to have you today on ET Now. Thank you so much for taking the time out and speaking with us today. I want to talk about you recently sold that older MR product tanker and took delivery of comparatively younger MR product tanker as well. Tell me, what kind of efficiencies does it really bring on the table for you with regards to financials? Also, are you anticipating any further changes in your fleet?
So good morning. Thank you for having me. Yes, we've been doing these transactions now for the last 9 months. We've already sold out 4 ships, which are among the older vessels, and we have replaced them with slightly more modern ships of the same kind. This is twofold. One is some of these ships are more, so for example, of the ships that you have on screen, Jag Priyanka is slightly more fuel efficient than the Jag Pranam, and therefore that improves the efficiency, the operating efficiencies. More importantly, beyond a certain age, and you know that we are international operators when it comes to our ships. So beyond a certain age, it becomes difficult to meet our international customers' requirements with ships when they cross the age of 20. And therefore, we like to replace them with more modern ships. So that is the main reason, rather than even say the operating efficiency. We want to maintain our position in the international market, and that's why we've been doing these replacements.
Hi, good morning. Thanks for joining us. I just want to understand for a moment, because you're running such a large fleet, where do you get the entire fleet serviced, repairs? And as you said that your preference is towards modern and newer ships, where do you buy them from? Because the reason why my question is coming from is that India and the policymakers have been trying to, kind of gradually develop an entire shipping economy, because we are such large users, and we are also taking initiatives to move a lot of our traffic from roads to the ships on the coastline. Before that, we need to have proper repairs, availability of ships, all of that. So, as a consumer yourself, how are you managing all of it?
So let me take that last bit first, which is, yes, we think that there is a lot of scope for shipping around the coast of India and for making the entire supply chain more efficient around the coast of India by moving from road to shipboard transportation. And we have been advocating this for at least the last 15 years. It's good if this can come up, and with a good network of ports and connectivity. We are there to meet that requirement if it comes up. Second, your question was on where do we buy our ships from? We buy our ships in the second-hand market. We are we don't issue equity as a company, and we have strict balance sheet criteria with regard to how much debt we take. So we have to stretch each dollar to the maximum extent. And we find that we make the best returns when we buy second-hand ships rather than new ships. So we tend to buy more second-hand ships, which may be 5 to 15 years of age, in order to get best returns on capital and therefore deliver best returns to our shareholders. So, and we buy them in the international market, and this is a very liquid international market. So it's so we are able to execute those transactions in the market. Coming to your first question, where do we get these ships repaired? The maintenance happens typically where the ships are trading. If the ship is trading somewhere on the Middle East, then you may get it repaired in the Middle East. If it's trading in Southeast Asia, you may get it repaired there. If it's trading in the Far East, we may get it repaired there. So it depends on where the ship is really, where we decide to do the maintenance. And there are maintenance facilities across the world.
The other thing I also wanted to talk about was what really is happening with the dry bulk market right now. And if one specifically talks about the LPG segment, the fact that spot rates have actually come down in the first quarter quite drastically, what I wanted to understand is whether does this really impacts you materially, or most of your contracts are long-term leases?
So again, two different sectors. So let me look at dry first. Dry bulk is very heavily dependent, or the dry bulk trade is very heavily dependent on what happens with China. If China slows down steel production, iron ore imports, coal imports, then it's going to affect the market significantly. So far this year, that has not happened. So the market is held up, dry bulk market, freight market is held up reasonably well. However, there seem to be some signs of a slowdown in steel production, some signs of a slowdown in iron ore imports as well into China. And that's a little bit of a concern. This is not yet being seen really in the rates for the big ships, which are really the ships that transport iron ore and coal. Uh, but we are but this is a little bit of a concern going forward. Coming to LPG, yes, the rates had dropped year on year. However, our 4 LPG ships are all on fixed rate contracts, 1 to 2 year fixed rate contracts, so it did not really affect us. In fact, when the rates were high in the early part of 2024, we locked in 1 to 2 year contracts, so we are running at very profitable levels on those ships currently.
Sir, just out of curiosity, just to understand your sector better, Mr. Shivakumar, if you can help us understand, you have such massive margins of 60%, very good cash flow situation, surplus cash on books, and profitability outlook of what? Almost 3,000 crore on an annual basis. And still the company is trading at 20,000 crore MCAP. Usually, what are the multiples a company such as yours usually trade globally? Just want to understand.
So there is no one number or even group of numbers, different, because there are so many different models out there. There are high debt, high revenue visibility companies. Ours is a low debt, low revenue visibility company because we have a large part of our fleet on the spot market. So again, it's difficult to forecast. So the one thing I'll say is it's always dangerous to do Q1 into 4 in our business because so much of the capacity is open and subject to the vagaries of the spot market. So 75% plus of our operating days are open. And therefore, it's difficult to do a forecasting. If the market turns, then the profitability can come down. On the flip side, if the market gets stronger, it can even go up. And that is maybe one of the concerns. I don't really know because we don't get into valuation discussions with our investors. We only discuss the fundamentals of the business.
Just curious about how to look at it. I don't want to comment on how the company valuations are. But anyways, thank you very much for help us understand that as well as the business trajectory from here on.